Imagine waking up every single morning to find fresh cash deposited directly into your brokerage account without lifting a finger. That is a seductive promise of dividend investing. But the strategy you choose today will determine if you retire rich or broke. Most investors are torn between buying a simple, diversified ETF or chasing the higher yields of individual powerhouse stocks. In this video, we are pitting the world's most popular dividend ETF against 3 legendary individual stocks to see who wins. We will analyze the yields, the risks, and the total returns to find out which strategy actually puts more money in your pocket. If you choose the ETF, you get safety and diversification, but you might be leaving massive piles of cash on the table every year. If you pick individual stocks, you could beat the market significantly, or you could watch your portfolio crumble if one fails. Our champion for the ETF corner is the Schwab US Dividend Equity ETF, known by its ticker symbol SCHD, a favorite among investors. SCHD has become the gold standard for passive income because it tracks the Dow Jones US Dividend 100 Index with a very low fee. This ETF does not just pick any stock. It filters for companies with a 10-year history of paying dividends and strong cash flows. Currently, SCHD offers a dividend yield sitting comfortably around 3.5%, which is well above the broad market. The beauty of this fund is that it automatically rebalances, removing the emotional stress of deciding which stocks to buy or sell. Over the last decade, this ETF has delivered an annualized return that rivals the S&P 500 while providing much steadier income. Its top holdings often include massive, profitable giants like Home Depot, BlackRock, and Cisco, ensuring your money is very safe. However, the downside is that you will never see the explosive, double-digit yields that you can sometimes find in individual picks. You are effectively trading the possibility of exceptional returns for the certainty of good enough performance and lower volatility. But what if you are not satisfied with good enough and you want to build a cash flow machine that pays your bills right now? To beat the ETF, we have selected 3 individual dividend titans that represent different sectors and offer unique advantages. Our first challenger is Realty Income, ticker symbol O, famously known as the monthly dividend company by income lovers everywhere. Unlike most companies that pay quarterly, Realty Income pays you every single month, making it perfect for replacing your salary. This real estate investment trust owns over 15,000 commercial properties, including 7-Eleven stores and Walgreens. Because it is an REIT, it is legally required to pay out 90% of its taxable income to shareholders like you as dividends. Right now, Realty Income offers a juicy dividend yield that hovers around 5.5%, significantly higher than SCHD. This company has raised its dividend more than 100 times since listing on the NYSE, proving it can survive any recession. The main risk here is interest rates. When rates stay high, REITs can struggle to borrow money cheaply for their property expansion. But if you want immediate income that hits your bank account 12 times a year, Realty Income is a powerhouse that is hard to beat. Our second challenger brings massive energy profits to the table, and that is Chevron, ticker symbol Chevron, an oil and gas supermajor. Chevron is a cash flow monster that has increased its dividend for over 35 consecutive years, making it a dividend aristocrat. With a dividend yield typically around 4%, it offers a nice middle ground between high growth and high immediate income. The company has an incredibly strong balance sheet and uses its excess cash to aggressively buy back its own shares from the market. Share buybacks are great for you because they reduce the total share count, which increases the value of the shares you still hold. However, investing in energy stocks comes with the risk of volatile oil prices, which can swing wildly based on global geopolitics. Despite the green energy transition, global oil demand remains robust, and Chevron is positioned to generate profits for decades. Our third and final challenger is a consumer staple giant PepsiCo, ticker symbol PEP, the company behind Pepsi, Lay's, and Gatorade. PepsiCo is a true dividend king, having increased its dividend payout for more than 50 consecutive years through every crisis. This stock offers a dividend yield usually sitting around 3%, which is lower than the others but comes with extreme safety. The secret weapon of PepsiCo is its pricing power. When inflation goes up, they can raise the price of chips without losing customers. This allows them to grow their earnings consistently and pass those profits on to you in the form of predictable dividend checks. The risk for PepsiCo is changing consumer habits, as more people look for healthier options and avoid sugary sodas and salty snacks. Yet, PepsiCo has successfully diversified its portfolio into healthier products and energy drinks to keep their growth engine running. Now that we have our three challengers, let's compare a portfolio of these three stocks directly against a diversified ETF SCHD. If you bought equal amount of Realty Income, Chevron, and PepsiCo, your average starting yield would be roughly 4.2%. That is significantly higher than the 3.5% yield you would get from SCHD, meaning more cash in your pocket today. This three-stock portfolio gives you exposure to real estate, energy, and consumer staples, which are all defensive, essential sectors. However, you are taking on what investors call concentration risk, because you're betting your financial future on just three firms. If the government passes a law hurting oil companies, or if real estate crashes, a huge chunk of your portfolio could drop overnight. With the ETF, if one company fails, it is automatically removed from the index and replaced, protecting your capital from disaster. SCHD actually holds both Chevron and PepsiCo in its top 10 holdings, so you're already getting exposure to them by owning the fund. The real question is whether you want to actively manage your positions, or if you prefer to let a professional index do the work. If you are a retired investor who needs the maximum amount of cash right now to pay bills, the individual stock portfolio wins on yield. The monthly checks from Realty Income combined with the high yields of Chevron create a powerful income stream that is hard to ignore. But for the vast majority of investors who are still building wealth, the SCHD ETF is likely the superior long-term choice for growth. The ETF provides a perfect blend of dividend growth and capital appreciation without the headache of monitoring individual company news. History shows that very few individual investors can consistently pick stocks that outperform a high-quality index fund over 20 years. Furthermore, the qualified dividends from SCHD are taxed at a lower rate than the ordinary income dividends you get from an REIT like O. This tax efficiency can make a massive difference in your net returns if you are holding these investments in a standard taxable account. So, the verdict is clear. Buy the individual stocks if you need to maximize current yield, but buy the ETF if you want total returns. A smart compromise for many aggressive investors is to make SCHD the core of your portfolio, perhaps 70 or 80% of it. Then, you can use the remaining 20% to snipe individual stocks like Realty Income when they are trading at a bargain price. This core and explore strategy gives you the safety foundation of the ETF while allowing you to boost your yield with select picks. Remember that dividends are not free money. They are a distribution of company profits that you must reinvest to see true compounding. Whether you choose the ETF or the stocks, the most important factor is your ability to stay consistent and never panic sell in a crash. I want to know which side you're on. Are you team ETF for the safety or team individual stocks for the higher yield and control? Leave a comment down below with your top dividend pick for this year, because I might feature it in an upcoming deep dive video. If you found this breakdown helpful, please destroy the like button to help this video reach more investors looking for financial freedom. Make sure you're subscribed with notifications on so you do not miss our next video, where we reveal the top 3 undervalued growth stocks. Your financial future is built one dividend check at a time. So keep investing, stay disciplined, and I will see you in the next one.